Okay, so VA loans, again, they're not necessarily given by the government. Okay, the government's not the one funding the loan. A VA loan is basically the government, the VA specifically, Department of Veterans Affairs, saying we are going to guarantee this loan. Okay, we are going to back this loan for taking on that risk from the lender of having 0% down, or the whatever it is, whatever the risk parameters are with the loan, and saying we're going to do this, we're going to cover you, allow the loan to go through. Okay, because it normally wouldn't. Now, what they do in exchange for that is something similar to FHA. So they have something called a funding fee. Okay, the VA funding fee is basically a fee that protects the loan. Okay, think of it, if you've heard about MI. Okay, it protects the loan in case you default. So it's money that is given to the VA so that in case of default, they can pay back the lender or the servicer whatever percentage is owed. Okay, that's a real high level way of thinking of it. But the amount of the funding fee depends on how much you're putting down. So if you're taking 0%, or if you're putting 0% down, you're going to have the highest funding fee. Okay, the more you put down, the lower that funding fee is. Now, what happens with that funding fee? That funding fee gets rolled into the mortgage. So if your loan amount is $100,000 and your funding fee is $3,000, your loan amount, which is what's going to be creating your monthly payment, will be based on $103,000. Again, these are just estimates, made up numbers to make it easy for you to understand. Now, if you want to keep your monthly payments low, a really good tip is pay that funding fee up front at closing. You are allowed to pay that out of your own pocket, okay, added to the closing costs. You don't necessarily have to roll it into the loan amount. You don't have to take that higher loan amount. Now, most people do because it lowers their costs. But again, if you're payment sensitive, I've had plenty of clients where we wanted our payment to be under a certain amount. I said, let's do this. They did it, and poof, they're very happy. They were happier putting the money out up front rather than have it added into the monthly payments. Because remember, you're paying interest on it. So, over time, it could be a nice savings. So talk to your lender, make it make sense. Okay, it has to make sense for you and your situation in order for that to be the right plan. So again, the other benefit to a funding fee, though, not benefit, but if you're a veteran and you are 100% disabled, or based on your disability level, you may not need to pay a funding fee. Isn't that nice? Yeah, it's a really great thing that most veterans don't even know. If you're disabled, talk to your lender, find out if you even need to pay that funding fee. So a couple things to learn about funding fee. 1, you can pay it out of pocket. 2, it's there to protect the lender and VA, basically, in case of a default on the mortgage, to help fund that so that they can, because they're giving these loans or allowing these loans to go through from the lenders, and they need to pay the lender that insurance, basically. Okay, they're guaranteeing the loan. Number 3, if you are disabled, any capacity disability, make sure you tell your lender that. Have them research it. Make sure that they're giving you the right benefit that you are offered.